Hi, my name is Reed Silverne. The name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker and proud of it. And there's my logo. Everything I say today is actually live to tape. And today for me, it's Friday the 19th of December. For you, we'll be watching it on Sunday the 21st or Tuesday the 23rd. Consequently, I have to say Merry Christmas to everybody and Happy New Year, because I won't be doing another show until January 2nd. So this is the only show. It's going to be replayed a couple times, and I'm sure that if you watch it twice, you're going to be even more fascinated or bored, as the case may be, than usual. Today I'm going to talk about a couple things, but before I get into the whole economics thing, something happened that is really strange and sounds like something out of a James Bond movie. Over here is Italy. There is Tunisia, and there are a number of kind of trunk lines, communications lines, I don't know what you want to call it, but the trunk of the relationship in the internet between Europe and the Middle East is run between Sicily and Tunisia, and another line goes to Egypt. Another line probably comes in through Turkey. And on Friday, which is today, 3 of those lines were cut. Now, all they said on the news story is that they were cut. So I'm very, very interested. These are underneath the sea, hundreds and hundreds of feet, maybe thousands of feet below sea level. And how did they get cut? There was another incident in January of this year, January 2008, where they were cut in 5 places and knocked out all the internet, not only to the Middle East, but also to India. And one of India's biggest industries is phone calls and so on and so forth, internet connections and software that's relayed by internet. So who knows what's behind it? It could be a James Bond type thing. There could be an actual submarine or something like that that's going around cutting these lines, or it could be movement underneath the sea. It's a very volcanic and earthquake-prone area, although I haven't heard of an earthquake the day that these things were reported to be cut. But it's very, very interesting to me that the relationship, internet connection between the Middle East and South Asia, which is Pakistan and India, and Europe, where probably there are more servers and so on and so forth, is that tenuous. And of course, there's undersea lines between the U.S. and Europe that probably feed Africa and the Middle East. So this is a real threat to the internet. I would like to know more about what caused this and how this happened, and even more so about the incident last January, or January of 2008, I guess it's still this January, where they were cut in 5 different places. France Telecom actually has ships that go around and probably have these undersea auto submarines that go around and actually fix the internet cables that go underneath the Mediterranean Ocean. So I don't know what the details of this are, whether which countries got cut off, whether Israel has its own or is connected to Egypt. But it's a very interesting situation that I probably won't be following, because, to be honest with you, this story that I saw is the first story that I've noticed of its kind, although I do remember, I don't know whether I talked about it or not, seeing a story last January when these lines were cut the first time. So the internet, which the nation and the world has, world commerce has become more and more dependent on a certain amount of actual commerce and sales, although it's only like 2 or 3%. inside America, but it's much higher in other places. All of the Facebook, but even more so and more important, the governmental agencies connected by the internet, and the companies and the internal company webs that run the business systems, the accounting systems, and so on and so forth in many, many major companies could be compromised by something like this. Cut between the U.S. and Europe could upset the financial markets, and who knows what happened. As far as this particular issue is concerned, most of the service will be back by the 25th of December. Take into account that this happened on the 19th. That's 6 days of internet disruption, and everything will be back online by the 31st. And that would be 12 days of disruption right here at Eid, or in the Muslim world, and Christmas in our world. So this is a very interesting situation. I don't know whether I will hear anything further about it, but I thought it was an interesting thing, and I figured I would talk about it. My first issue, and that wasn't my first issue of the day, concerns credit cards in the banks. Now, I've talked about, probably to the nausea of most of the people watching, about why the credit card system has gone sour, and why the banks need to charge so much and to cheat. I shouldn't say cheat because this is legal, but there is a chance that as of 2010, new rules were just issued by the Office of Thrift Supervision, which is in charge of making rules for credit card issuers, about some of the deceptive practices and unfair practices that have come about. Now, there was a 300-page report that was issued by the Office of Thrift Supervision, and in it, it said the word deceptive 100 times and unfair 300 times. So all of these little tactics that the banks use to maximize profits and to really, I can't say it otherwise, to screw the holder of credit cards are going to come home to roost and probably be eliminated, but not until 2010. And I wonder why. And I think I know why, but I wonder why. Now, we have a giant problem with credit card debt, and why it's becoming harder and harder for people to get credit cards, why the banks have been taking your limit, giving you a limit of $10,000, you run up $5,500, and then cutting your limit unilaterally to $5,000 and saying, now you're $500 over limit, and we're raising your interest rate from 9% to 29% on all the difference, and refusing to let you borrow anything else right at Christmas time. So that's getting to be very, very typical. And basically those increases, not just changing the limit and then increasing your interest rate, but having a 21-day grace period, and then calling you 5 days into the grace period and saying you have a late payment, even though you haven't gotten your bill yet and you don't know how much to pay, and then taking your entire balance, which could be $2,000 or $3,000, saying now your posted limit or your posted interest rate's 9% or 9.9% APY, but we're going to increase it to 29% because you're a deadbeat that paid late. But you haven't even gotten your statement yet. You don't even know how much you need to pay. So this has become very, very common. These new rules will basically say there is a minimum 21-day grace period. If the bill is due for December, on December 31st, you basically have until January 20th to pay your bill. And on top of that, the new rules will say that the bank has to send you your statement 21 days before the end of the grace period. So basically, they have to tell you how much you owe when you owe it, and then you have 21 days to pay, and they can't increase it. However, if you miss a payment, and it's more than 30 days late, they can charge you retroactive interest rates. The retroactive interest rate issue alone costs customers of banks $11 billion a year. The banks are basically cheating the customers, legally cheating, out of $11 billion a year by saying you have some problem, you're 5 days late, or you're 1 day late, or you're 0 days late, or we have cut your limit and now you are over limit, and then increasing the entire balance of your credit card up to 20% higher interest than you're already paying. Basically, what this does is create credit card slaves, and there's lots and lots of credit card slaves out there. People who can only pay the minimum and will never, ever, ever get out of debt. And what is forcing that? Why would the banks do that to people? Well, I'll tell you. First of all, they want to maximize their revenues, but the banks are losing money. They're losing money because they actually bought derivatives that turned out to be complete, totally worthless frauds. Things that the Madoff securities firm couldn't even imagine doing have been done by this debt securitization industry, legally, unregulated, and basically just an incredible multi-trillion-dollar fraud on the American people. And one of these derivatives, one of many, it's called pay-through debt securitization. And what it's for is debt that is impossible to measure. And one of those debt pools that are impossible to measure is credit card debt. So these issuers of these fixed income bonds, so to speak, pay-through bonds, basically told the customer you were going to get 6% interest over a period of 20 years, and what the asset that they were backed by were a pool of credit cards. Now, think about it. You have your credit card, and you owe, you have a balance that you can charge up to of $5,000. You keep a balance on it about $1,000. But in any 1 month, you could just pay off that balance. And then there's no interest income from that balance at all. And that's true with the entire number of credit cards that are in this asset pool that supposedly backs up this derivative. Now, I will tell you that these derivatives recently became apparently and obviously worthless. The basis of the derivative that were bought by banks, by retirement funds, is ridiculous. How can you guarantee an income from thousands and thousands of credit cards when you don't know whether those credit cards will be paid off? It's possible that every single the balance of every single credit card will be paid off the next month, and the real income from that pool of credit cards is zero. And yet, supposedly, they are going to pay through the guaranteed 6%. The whole idea was ridiculous. Any company and any rating company that rated these as anything but worthless wasn't reading the contract or understanding the instrument. And they're called pay-through because they pay through regardless about how much income the actual pool was going to generate, because nobody knows. And the same thing happened with car loans. I'm going to get into the rescue of the car companies in a minute, and credit card debt. So what happens when these issuers owe 6% per year, guaranteed fixed income bonds against this pool of credit cards? They are going to do everything they can to force income out of these credit cards. So on any possible excuse, even though you actually received a deal where the company said, you have an outstanding balance in another credit card, transfer your credit card to us. Your outstanding balance at, let's say, 19% will be have a teaser rate for 1 full year of 4.9%. And any new charges that you charge against that card will be at 9.9%. However, what they don't say is that even though they haven't sent you a bill, when you pay that card, after you've received the bill and then you pay that card, they will count it as late, and they will take that balance from that other card plus the balance that you wrote up to the payment point, plus the balance that you are now writing during the grace period. They will ignore the grace period and say, you just had a late payment, so now we will charge you 29.9% on everything, your entire balance of that card. And that's going to offset another card in that pool where somebody actually just paid off their credit card. And somebody pays off their credit card. It's the worst thing in the world for these derivatives, debt securitization guys, because if they pay off the card, well, there's no income at all from that. So basically, we have to cheat people. We have to lie. We have to scheme. We have to put into the deal in the tiniest print on page 59 of an agreement that was posted on the web, that wasn't even in your documentation when you signed it, that the interest rate can be raised at any time for any reason. And that is in almost every credit card agreement. If you have a credit card, and even though you might get that 2 pages of fine print, I can assure you it is somewhere that they can raise their interest rate at any time for any reason. These new regulations, the Office of Thrift Supervision, will cancel that, will make that illegal, basically. However, those rules won't go into effect until 2010. Why won't they go into effect until 2010? They don't want to endanger the banks who just robbed, who were just bailed out for $350 billion, not million, not thousand, $1 billion out of the TARP fund that was agreed to, and there's another $350 billion sitting there on the block, ready to be given to banks who have no reason at all not to steal from you, to protect people who issued fraudulent debt securitization in the first place. Is that a bad deal? Yes, it is a bad deal. Can we let those banks collapse? Well, obviously we couldn't, or else we wouldn't have passed the bailout in the first place. But we have a problem. The old method of reselling credit card accounts has disappeared. The only thing that was left is this fraudulent and broken and stopped and stalled debt securitization system that was created as a by thieves to rob us, and which has brought a very, very close, just an inch away, thanks to Office of Thrift Supervision and the Federal Reserve and some other institutions that have stepped forward to basically save the financial system from a complete meltdown. The meltdown did start in September and October. We're experiencing a recession as a result, but it didn't go all the way. The London Interbank operational rate had gone to, overnight, had gone to 4%. Where if you pulled money out of your ATM machine from Bank of America and you had your account with Wells Fargo owed 4% just for the $200 you just pulled out. That has gone to 0.12% and is very low. So now the liquidity crisis is over, but we're left with the problem that we've broken our financial system. And now we go to the automakers, and the big three, which is Chrysler, Ford, and GM. Basically, Ford said, we don't need a bailout loan. And the reason we don't need a bailout loan is we had reduced our capacity to pretty much what our sales were going to be, and we hoarded cash a couple of years ago so we can get through this bridge time, even though we are not making any real profits. However, Chrysler, which was basically sold off a couple of years ago by Mercedes-Benz a few years ago, and they were taken over by a hedge fund called Cerberus, and they were taken private. They don't have to tell anybody how they're doing, but basically they were failing. And then, of course, there's GM. GM has had a lot of problems for a long time. The main problems that GM have are just gigantic liabilities due to very, very generous health benefits for retirees and very, very generous retiree systems, so that GM is really being brought down not by the rates that are being paid to the UAW workers right now, but are being brought down by the generous deals that were made to support retirees that are now retired or laid off. And on top of that, there's another thing, another little wrinkle that's causing tremendous costs that's draining cash, and that is the job bank. During the last so many years, GM has laid off many, many people, and those people are eligible to get bridge between their old salaries and unemployment. Then when their unemployment lets out, they end up with 95% of their salary given by GM. Obviously, they cannot support people who are not currently working. But the Congress, when they were considering the bailout, some of these Republican senators basically said to themselves, well, you know, we lost Ohio, we lost Michigan, we lost Pennsylvania, we lost some of the states in the Midwest. So we are going to really crush the people of the Midwest. We're going to collapse the entire auto industry, which is really being beset by a loss of clients who are being denied car loans. The problem isn't the cars. The problem is the car loans. Basically, from last year, when GM was all still in trouble, they had sold 16 million units. Now they're down to 12 million and dropping. But it's not just GM. It's not just Ford. It's not just Chrysler. Nissan has lost 30% of their buyers. Toyota and Honda have lost very, very large percent of their buyers too. So basically, the financial system is no longer supporting the car makers and the car dealerships. They're not giving the car dealerships enough credit to be able to buy the inventory from the companies, from the car companies, even the foreign car companies. And when somebody comes in to get a car loan, think about it. We can all, if that car is priced right, and they leave the next day, they put a down payment that covers the depreciation, the automatic depreciation, you should be able to go out there, repo that car, and get back the value. And on top of that, that guy has to have car insurance. If that car gets cracked up and it's totaled, then the people who give the car loan get their money back. So where is the risk? Why does somebody have to have a 700 credit score to be able to buy a car? It's ridiculous. And it's necessary because the system to finance car loans was broken. And broken by what? Yes, this debt securitization, these derivatives, these pay-through derivatives where people bought pools of car loans, just like they bought pools of credit card accounts. And even though somebody could buy another car and pay off their car loan at any time, they were still required to pay through. So when that system broke, the old system being able to sell car loans to other companies to service those car loans during the life of the car disappeared. So basically, somebody gives somebody a car loan, they gotta live with that car loan through the life of the car, whether they have a repo guy and that infrastructure or not. My name's Reed Silverne. The name of this show is Fed Pride. I really appreciate your watching, and I want to say to everybody, have a very Merry Christmas, a Happy Hanukkah, and a very Merry New Year. Thank you.